Up, everybody? How you doing? Good morning. Happy Wednesday. Welcome to the morning show here on Stock Market TV. Got a good show today. Me, obviously. I got Strazza. I got Fonz. Sadly, no JC today. He's taking his kid to do a thing. He'll talk about it tomorrow, I'm sure. And I'm sure there will be a good story out of it. But we got a lot of stuff. My dock is full. My heart is fuller because I'm here with you. So I'm happy. New guest on the show, man. We are so many new guests lately. We're rolling. Warren Pies. He is the founder of 314 Research. He'll be on the show at 9. Of course, we'll hear from Kenny. We'll hear from Mary. So much to discuss between the breadth and the earnings and the small cap and the thrusting and the news. A lot going on. Like I said, full doc today. So let's go.
Good morning.
Hello, sir.
How we doing?
Good. First order of business, 2 things. Number 1, changing that logo in the corner to
Bang.
Strazza Show.
Bang.
Secondly, everybody, today is Steve's birthday.
Oh,
happy birthday, Steve. I thought about putting the happy birthday song in my mixer and doing the thing, but I thought that'd be cheesy. That'd be too much for you. I thought you would be content with just a simple happy birthday.
We don't need that.
We don't need that.
Thank you. Feels good. Nothing I'd rather be doing on my birthday morning than a Strazza special show.
Hey.
Also, I see the chat very excited about the one Warren Pies coming out today. I'm excited also. Big fan of Warren's research. So that'll be an awesome discussion. We're going to talk all about breadth, try and figure out what's been going on here since last week. I think that's really important. And I think we'll spend most of the show talking about that. And you said we got some news developments. So that's always
fun. We got so many just random news stories. Some things that probably just don't matter that caught my eye yesterday. Couple of things that probably matter a little bit. The semiconductors story overnight here probably matters a little more than like some random news for a random company. But like I said, a lot going on today. So shall we get into some state of the markets?
Please.
All right.
Did it. Some questions coming in the chat. Ask him when Warren's here, and we'll definitely get to commodities. I wanted to ask about oil as well.
Isn't energy that's his bag?
It is. So I want to talk about small caps. I'm trying to get the deck here.
Yeah, who doesn't, man?
I mean, how can you not? How can you talk about anything else? The price action that we've seen since last week. Where's that Russell 2000 chart? It should be first in the deck. The price action that we've seen since last week is just small caps are screaming at us. You got to be listening. Like Russell 2000, I'm picking up what you're putting down. Look at this one. We're going to remake this because it's very ugly. I just did this real quick in TradingView. But this is measuring the 5-day rate of change. So since, I guess, Thursday of last week now, Wednesday, right? Because we had Powell in front of Congress. That really started things.
Yeah.
Cold CPI. The cold CPI. We had breath thrusts, by some measures. They call them the 70/70, 3 days of 70% advancing stocks. That triggered Friday before all the craziness of this week. Right. And now we just keep thrusting. We got the whaley yesterday. But this isn't about breadth. This chart is showing momentum. This is a momentum thrust. This is initiation. This is the kind of stuff that we see at starting points, at the beginning of trends, not the end. So there's a lot of, really interesting and intelligent takes, I think, on the internet and in the news right now about how strange this is to get these thrusts so late. If you look at a chart of the S&P 500, it is strange to get a thrust at all-time highs when, this bull market is not new. We think it began in July of 2022. It's 2 years old. Very strange to get a thrust on a chart that looks the way the S&P 500 does right now.
Well, new for
What's
small caps.
what's not strange is to get a thrust on a chart structure that looks like this, that looks like small caps, right? I'm talking about this kind of stuff happens at the beginning of trends. What have we been saying about the pattern in the Russell 2000, Spencer?
Sorry, I was reading Billy Cunningham's comment. I was distracted. What'd you say?
So what we've been saying about the pattern in the Russell 2000 is that the trend reversal has not even completed yet. We've been saying that all year and last year. Look
Yeah,
at
we've
the
been waiting.
range, right? It just completed. This is now a valid trend reversal, and it did it in a very decisive, authoritative way, right? Blow out momentum, blow out internals, and then also just blowing out the relative trend too, right? If you look at small caps relative to NASDAQ 100, S&P, anything, absolutely crushing. And you're getting thrusts and momentum there that really stands out when you zoom way out on the chart. So I just want to, yeah.
Couldn't we just say this is very simply a reaction to Jerome Powell's sentiment last week and the realization that, oh yeah, we actually are going to get a rate cut in some probably September, but more importantly, rates are going to head in the downward direction, and that's the period we're now entering.
Yeah.
Lower rates, good for small caps,
It's
high
really,
rates, not so much.
Yeah. It's a double whammy, right? It's definitely bond market, right? Because we've talked about this is the interest rate sensitive rally, right? Regional banks, real estate, ARC stocks,
Yeah.
biotechs, whatever. The rate stuff really work. Home builders, look at home builders, right?
So that's all this is. This is just a reaction to Jerome Powell.
No, it's a double whammy, right? It's political too. Whether that's right or wrong, it's election cycle stuff too. So what we saw at this first green circle, you know when this was? So last time we had a 5-day rate of change like today's, besides the pandemic, which was just the most unusual momentum reading we've ever seen off of the lows.
Wait, out of curiosity, what's so special? Did anything happen? That was 2016.
November 2016, the election happened.
Oh.
You're getting the market reacting as if the election happened 3 months early or 4 months early since last week. On top of this bond market catalyst of lower interest rates, and you have the dollar breaking trend, right? So all of these things just at the same time got thrown at the market, I think. I think it's a combination of a lot of stuff. It doesn't matter.
That is interesting.
Yeah, it doesn't matter the reason though, right?
I don't. That's what JC would say if he was here. I don't necessarily agree. I think reasons matter because they can tell you sometimes when things could change, or more importantly, why they could change. Right. So it's not always you. It's sometimes it's a waste of time and energy to prescribe a reason for every move. But in this case, I mean, come on, right? Pretty obvious, I think.
Yeah. And look, all of these things, all of these developments, right? Because we talked about the predicted polls and Trump's odds spiking, and we had the debate debacle, like last week. So you got some action there with them pricing in what looks like a better chance of us knowing who our next president is now. And then you also have the bond market developments. All the Powell stuff last week was huge. He was talking about bank deregulation, right, in front of Congress a ton. So the banks loved that. Then you had rates come down, the home builders and everybody else loved that. So I think it was just, a big combination of things that all hit the market at the same time. And that's why we're getting such a big splash. So if you go to the next chart, this one's called the Whaley breath thrust. Let's just go through right down the line. And we're focusing on the S&P 500, but then we're going to go back to small caps. Whaley breath thrust. Look back periods 5 days. So over the trailing 5 days, advanced decline ratio about 3-to-1 gives you a Whaley breath thrust. These are super rare, Spencer. This chart goes back to the 1940s. These are very rare readings. We had one coming off of the fall lows last year. I believe it was in December. No, maybe it was November of last year. Now we're getting another one, right? Late cycle breath thrust for sure. At least it feels like when you look at the price chart. Now, if you look, this one has pretty much a perfect track record. And this is really important. So look at the track record here. If you look out a year after this reading, it has a 100% success rate, which always freaks me out. Whenever I see 100% success rate, I'm like, it ain't going to work this time. But it's a good thing. Don't think like me. I'm a skeptic. The last time we hit in June of 2020, that's what I'm talking about, those readings off of those pandemic lows, 30% over the trailing year. Look at the forward returns after these whaley breath thrusts. We just got one and we're doubling up. We had one in November of last year also. It can only be a very, very good thing. Now let's look at more stats. This is the 70 thrust that I referenced earlier.
Oh,
Right?
whoa. A lot of numbers here. Hard to read. Just describe this. What's going on?
3 straight days of a 70% advanced decline. 96% win rate looking forward 12-month returns, and an average gain of about 22%. Okay, let's move on to the next one. Hopefully we can see it better. Okay, this is my favorite. This is really our breath thrust that we lean on more than anything. Keep it simple. 20-day new high indicator. Right? When it triggers over 55%, to us, that is a thrust. It's only been wrong once. When you look out at the 12-month returns, the average gain is 17%. It's got like a 96% win rate. We had one October of 2022. We had one July of 2022. Right? That was the first reading. Very early on, you get these. Very, very early on. Maybe only beat sometimes by percentage of stocks overbought in terms of like the earliest breath thrust indication that you can get. We had another one October 2022. We had another one in December of 2023. Yesterday, we came in, Spencer, at basically 54.87%.
Wait, just real fast. I'm looking for now on this in this table.
Well, maybe stop looking and start listening.
Okay.
Yesterday, the reading came in at 54.87%. This is the stuff that we talk about behind closed doors. Grant's like, it's not 55%. I'm like, you round that up. It's like, I don't know. I'm a technician. We draw our support and resistance lines with crayons or markers or big highlighters, right? We round things up. Our price target's not 91.23. It's low 90s. If you get a reading of 54.9, I think that's 55%. Here's what really matters before we argue over 0.1%. What really matters is that the breath thrusts you trust come in bunches. They're delivered in giant baskets of breath thrusts. And everybody on the internet is talking about how their thrust is triggering. That's how you know it's a thrust. That's happening now. It's been happening since late last week, right? The thrusts are everywhere. So I think that 54.9% should be rounded up to 55%, and we count it. Then again, that begs the question, how could we get a breath thrust right now? Go to the next chart. These are also very rare, the 20-day thrusts, right? So this chart goes back to 2013. There were a lot off of the financial crisis lows. So this is just looking back like the past decade. These tend to happen at the beginning, very early on, right? Sometimes you even get it too early on, like we did in 2022, showing the first yellow circle in 2022, right? You got it in June of 2020, also coming off the pandemic lows. If we put another yellow circle on this chart at the current price, Spencer, that would look a lot different than these past occurrences. Now wouldn't it?
Yes.
I don't see new all-time highs with a thrust reading in the past.
Yeah, but usually they're in uptrends, right? Usually, except for the 22.
No, they're not usually in uptrends. I mean, would you call that an uptrend, the reading in January of 2019? Would you call it an uptrend in June of 2020? Maybe very short term, but well below the COVID highs. Look at the readings we got in 2022 at the bear market lows. We were building out a bottom. We were basic.
Yeah, 2022 obviously is not, but
I would call maybe the 2021. You have some sort of an uptrend there shaping up right after that V-shaped bottom. But still, I mean, the market just collapsed. People were very bearish back then. Very different than today.
Yeah, I guess the 2015 one too, because we were in a sideways range for quite a while.
Yeah.
All right. Stand corrected.
Listen, I promise you can trust me. I know this data set very well. You don't typically get breath thrusts when the market's at new all-time highs. But I think this breath thrust is a lot more about small caps than large caps. Large caps probably continue to participate and trend well. Go to the next chart. This is fantastic. This is so important, this kind of context. Put up the table. Yeah. If this bull market began, this is the standard definition, Spencer, so you should like this, of a bull and a bear market. 20% in one
20%.
direction, after 20% in another direction. That's how we're measuring it off of the lows. We're using the S&P 500. So this one began, say, October 12th, 2022. Oh, the famous CPI day, right? October 12th, 2022. Actually, it was 13th, the CPI day. The average return in a bull market period for the S&P 500 is 150%. Median return is 91%. We're at 60. The average duration of a bull market is over 1,100 days. We're at 440. We're not even halfway there.
That's interesting.
So the average duration, not even halfway there. The average return, we're like a third of the way there. So maybe to get a breath thrust this late, it's just confirmation. Hey, we're earlier than you think. We got a ways to go, Mr. Market. I don't know, right? I have thoughts. I have opinions. Nobody knows for sure what this breath thrust means. But when the S&P, on average returns 9% a year, and I can show you if you go back to like the first table, Alfonso, with the Whaley, that after these signals, you tend to get an average of 20 or more percent over the trail or over the forward 12 months. Nothing I'm saying right now could be interpreted as anything but bullish.
Now, okay, you've got the data. I don't have the data. You have the data, but you could forgive someone, Steve, for looking at the chart of the Russell over the last week or so and saying, "There's no way this thing can keep going like this," right? You could forgive someone for saying that.
In the short term, I feel the same way.
Yeah.
You know what I mean? Like the Russell 2000 is incredibly overbought. It's very stretched over the short term, but the short term is the short term. Investing and trading is a lot easier when you extend your time frame a little bit. That's why we do that. The longer term and the intermediate term trend, I mean, dips are to be bought in something like small caps. The other thing to point out, if you just go back to the first chart, Alfonso, we'll get a clean reversal pattern of the Russell 2000 marked up so we could show it. But this trend is just beginning. So we're getting this like starting line momentum, right as the base is breaking out. You know how we say, like, Spencer, if we get a breakaway gap or big volume on a move out of a pattern, we like it more. We're getting a momentum thrust. We're getting a breath thrust. We're getting, momentum thrust in the relative trends that favor small caps. Like everything is firing as this brand new bearish to bullish primary trend reversal prints. You couldn't ask for more confirmation is my point. So do you want to trust this rounding bottom or trust this trend reversal for small caps? I don't think I've ever seen a better supported pattern resolution than this.
I mean, look, raise your hand in the chat if you're underweight small caps. I'll start.
Yeah. So look, let me just finish up here. Now let's just go to this triple pane chart on 9. This is about small caps. Will large caps stop working? Highly doubt that. Highly doubt that. I think a lot of them will continue to be absolutely great, right? I don't think you want to. I'm not selling my large caps. Might sell some of them, right? But for the most part, we hold on to those. You just want to own more small caps now.
How dare you say so?
Yeah. So if you look down in red here, this is the percentage of S&P 600. That's the small cap S&P index at 20-day highs. This reading is just ripping, right? So it took out the reading off of the October lows from last year, which the large caps have not been able to do. If you look at the black line above, that's the S&P 500. Mid caps is in the middle, right? Small caps also eclipsed the short-term new highs extreme reading that we had off of the pandemic lows. I know I was just talking about this off camera. If I'm here saying things like we haven't seen this since the pandemic lows, or this reading, eclipsed the pandemic lows, the readings that we got in terms of breadth and momentum off of the pandemic lows in the first half of 2020 were absolutely historic. Some of the biggest readings we've ever seen. Small caps just beat that number. So my mind is kind of blown by this. I think everything that we're seeing since last week, it says, blue skies ahead for large caps, more good times for, the stuff that's been working. But this is really about small caps. This is really about small caps. I don't think that you can have enough exposure to small caps right now. Just do 12 and we'll finish it up, Alfonso. So S&P 600 stocks percentage of overbought readings. I mean, just absolutely monster reading. Actually, yeah, go to 10, actually. This shows it as well. If you look at something like the 200-day moving average here, in 4 days, we went from an environment, just look at the last line here, S&P 600 percentage above the 200-day. In 4 trading days, we went from half of the stocks in the Russell or in the S&P 600 above their 200-day. So you could argue in primary uptrends to now 3/4 in primary uptrends. It happened in 4 days.
Steve, wouldn't the thing to do now just very simply look at the relative trends of whatever you want to compare, small and large, whatever industry group, whatever sector, whatever stock even?
You still can't look at like a small cap versus large cap chart and be like, oh, a primary trend reversal is in. We're talking about 4 days, right? It will take time. But what we are seeing actually in the relative trend is like, that's initiation. That's how new trends begin, right? The bottom is in. So how long it takes, listen, after a run like the past couple of days, allow them to back and fill a little bit, let them cool off, let them digest these gains. You could be patient, right? There's a reason why I'm pointing out the forward 12-month returns when I'm talking about these readings. These breath thrusts I'm talking about tell you nothing about what the market's going to do the next day or the next week or even the next month. It's telling you what the market's going to do from a primary trend perspective, looking out quarters or years, right? So you could pick your spots, you could be patient to build that exposure to small caps, but that's the playbook now. The playbook has dramatically shifted, in my opinion, from the bigger the better, mega cap growth. I want to be in the AI names. Let's run the leaders, right? The chase that we saw for these leaders since, I don't know, December of last year, it's been incredible. I think that ends, right? Now you want to chase the small caps. It's all about the smalls.
Wow. A lot can change in a week.
When you get initiation readings like this, yeah. This is some rare price action. It's been a lot of fun. We've been doing a lot of breath work, just trying to figure it all out. So we're running some numbers now. Hopefully I can share before the end of the week. Really trying to focus on the differences between the timing between when we get a large cap breath thrust and a small cap breath thrust. Because usually, like at the pandemic lows, we get them both at the same time, right? Like in May, June 2020. This time around, I think we really are going to find that the real thrust is happening now for small caps, and we never got it back in 22 or 23. Even the one off of the October lows, it was good, but this is better. So I think this is the big reading that we really pay attention to this cycle and look back at and circle on all these charts. So that's all I got for breath. My rant is over.
Turns out the real thrust may have been the friends we made along the way. But let's move on and talk to someone who is watching things on a much more acute timeline. See what he thinks about all this. Mr. Kenny Glick. Let's get him on the show here.
It's been a long time coming. They ain't come from my club, they tugging. Putting up numbers, 99 pounds, and I still kept it 100. Hola. Yeah.
Yo.
What's up, ladies? Good morning.
All right. What's on the Glick, the House of Glick watch list here?
I don't know, but can you say breath thrust 3 times quickly?
I'd rather not.
Well, listen, I've been up since 6, and my generational lows on the Qs were broken this morning. So 490. Let's throw a chart up quickly. I'll show you exactly what I'm doing today.
Here we go.
So, ladies and gentlemen, if you've been paying attention, these earnings reversals have been working. You know, again, those bank stocks plays yesterday were awesome, but that was yesterday's news. Today's news is that we broke 490 on the Qs. So last Thursday was the first real selling that we had, that massive blow off top. We got down to the 490 print. It was a quick print, but we broke it this morning. There's the 490. I shorted the Qs, and I'm probably not covering unless they get back over 490 today. So again, with this shift of momentum, talking about what Strazza was talking about, I'm in. I want the Qs to act as the ATM machine as they are right now. People are pulling money out of the ATM to buy something else. And again, you saw all those biotechs moving yesterday. I'm sticking with the earnings, but I have to play the Qs short. I'm already short the Qs. But more importantly, Nancy Pelosi's indicator, UVXY. Okay, this thing is always going down. Okay, when this thing has a couple of days rally, especially what you saw yesterday, a rally into the close while the market was ripping higher too, that's a tell that the people are buying protection. And who are those people? They control the market. So seeing this market doing what it's doing right now, yeah, it's the chips and the news. So right now we're just going to stick with the chips and the news. I'm looking UVXY. If UVXY craters, it'll be just another buy the dip opportunity. But if UVXY stays elevated today, I'm going to probably stay short the market. And again, the market is the cues for me. But right now, that 490 is the line in the sand. If we get over it, I don't imagine a massive rally today. But if UVXY starts to tank, again, all bets are off. I'm a trader. I'll just play what I see. GameStop also in action this morning, my friends.
Oh, didn't see that coming.
Yep, GameStop had some activity yesterday. I came in looking for a short. I'm a VWAP trader. I happen to be awake this time at 7:15. Banged it out right here. Blue line is today's VWAP. Orange line is prior day. Perfect trade. Got a little bit oversold, and now we're back to break even right there. But yeah, going back to the earnings, there was one I want you to watch. AEHR was a forgotten name in the chip.
Oh, wow. Yeah.
Absolutely just decimated, did not partake in the rally. If anything, it had been going down. Somebody knew something a couple of days ago. This had a massive day from 9 and change. It power gapped above all that, and it's still holding the gap right now. This is ripe for a gap fade, but the stock was so heavily shorted that there's going to be a really, really interesting battle. That battle will be lost right here. You see the lows of the day at around $18. You break 18, you break prior day VWAP, this thing will probably crater right back down to the 17. So I'm looking to play the fade on this. But again, I'm a little skeptical because this one's coming out of the dungeon. And again, this is the first time it's shown some strength. So that's where my brain's at right now. Again, first time in a long time, the cues look like we got some more room to the downside. Let me show you this chart one more time. Talking about short term, I'm looking at a 30-day chart. It really shows you the whole thing. 30 days on a half an hour, just to crunch it all up. 30 days, half an hour, and you'll see where I think we can go to. So now that we broke down, let me just scrunch it all up. This is the last 30 days. I mean, June, we saw maybe 7 minutes of selling the entire month. So to give half of it back makes complete sense to me. So I'm looking, if the cues do give way in the next day or so, and again, today's just Wednesday, if this continues, I'm just looking for another, 8 more points to the downside. Everybody feels good. We'll find some support around that 481 area, and then we'll see who's boss, because Netflix is coming out on Thursday night, and then here come the tech earnings, and then every night it's going to be gap up, gap down. You're not going to be able to guess, and we'll just play the action.
It's like Christmas for you, Kenny. You got it. Not only is it earnings season, you got the UVXY, you got the Qs, shorting the Qs, making money. What more could you ask for?
I could have sold all my swing trades yesterday at highs, but I didn't. But we got out of a lot of that Jumama. We got paid on Sophie. I think I still want to give credit to Strazza. I think he was talking about this one. We bought the 750 calls, just goofing around at 9 cents. Banging them out at 25 and 30 yesterday. Nice sell out of the Sophie. But I still got some JMIA. I like the Jumama, but again, had the blow off top yesterday. We might have a continuation down day today. Look for that $12 area to put up some fight. But other than that, liquid as usual and ready to rock.
All right. Kenny Glick, I'm dropping the link to his room and the link to his watch list in the chat right now. He's going live in his room right now. So people in there, we're about to see him. If you're not in there, I know what you're doing. But he's there every day.
I'll see you live, babies.
All right.
Later.
Let me drop that link right now. First off, it's hittthebid.com, and I'm gonna bring up the QR code. If you want to get on Kenny's watch list, he sends out his watch list every single morning. It's right there in that QR code. Scan it. It's free. It doesn't cost anything. It costs like 10 seconds of time, right? It's quick. And then, of course, he's trading in his room all morning, every morning, like a machine. If you're not there, and you do day trade, you really want to be there. So check it out. There's the code, hittthebid.com. Okay, let's bring on today's guest. I think we're ready. All right, so another new guest. I've been saying it time and time again. I love having new guests on the show. Warren Pies spent many years at Ned Davis Research. Now is the founder of 314 Research. An expert on energy. I'm sure that'll come up. And on the note of new guests, if you're having, I do ask every so often, I'm going to ask again, if there is someone you want us to get on the show, drop their name in the chat. You can email us questions at stockmarketmedia.com. And I always look forward to suggestions and try our best to get new blood on the show. So, with that said, let's bring on Warren Pies.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Hi, Warren.
Right.
Hey,
Warren.
thanks for having me.
Welcome.
I don't think we've ever met, Warren, but I've been following your stuff for such a long time. So thanks for coming on. Really love your work.
Well, I appreciate that. It's good to be here. And the production quality and everything, pretty impressive stuff. So I like what y'all are doing. Well done.
Thank you. I noticed something funny about your Twitter profile. I've been calling myself a recovering corporate American in my profile for I don't know how long now. I see that you are also in recovery as a lawyer, recovering attorney. Is that right? So talk to me about your background and what you mean by that.
Yeah, I mean, so I was an attorney back in the day. I came into this industry through the back door, kind of. Yeah. I started out practicing law for 3 years or so and made the switch over to finance. And so in my profile, I say recovering attorney step 4. It's kind of like if you know the 12-step program, I believe step 4 is making an intense.
Sorry to everybody, right?
Well, I think it's the searching inventory. I'm in the process of the searching inventory of myself, or deep introspection, or whatever that is. And so I put that up many years ago. Like, I think I joined Twitter probably 10 years ago now.
That's so
and
funny.
Threw that in there. And so yeah, I don't know. I had a few other things I had to take down for compliance reasons, because I used to say highlighting when I'm right, downplaying when I'm wrong, and I thought that the compliance people realize that's just what everybody does.
Right.
But whether they realize it or admit it or not. So anyways,
you're wrong sometimes.
That happens if you believe it or not. It does. Yeah. But we like to just pretend it doesn't. So yeah.
Interesting.
So talk to us about your time at Ned Davis, because that's really, I think where a lot of us discovered your work. Were you the energy analyst? Is that right?
Yeah. I mean, I started out as a commodity analyst, and I ended up running the commodity team when I left. Yep. And so I was known for work on oil and energy. I started out writing on the energy sector, and started with like downstream and then incorporated midstream. I was the first person at Ned Davis to write about master limited partnerships, and I wrote about those. I had a big introductory report, and the lady at Barron's, the editor at Barron's, saw that report and said, this is like, she loved the report, asked me to do the roundtable on the Barron's roundtable on master limited partnerships. So that kind of was a nice accelerant for my career there.
What year was that?
That was 2013.
Oh, wow.
So yeah, I mean, I've been at it for a little bit now. And so, yeah, that's that. I did that for 10 years. And then at the end, NDR, love NDR, like what they stand for historically, but they were bought out by a private equity group basically, and kind of gutted all the research stuff. And then in 2019, they decided, look, we have to try and squeeze more money out of this thing. So they sold Ned stuff separately. They say they're going to sell my stuff separately. And bottom line is, I begrudgingly said yes. And then I said there was a bunch of conditions on that, and they didn't abide by the conditions. So we got sideways, and I left. And I basically was like, hey, if we're going to sell my stuff separately, let's just do it. I want to do it the way I want to do it. And with the people I want to work with. And so that's how 314 came about, really. It was kind of like pandemic volatility, and ultimately ended up being a major blessing, though. So I'm certainly not complaining.
Explain what you mean by that. I mean, we all thought in February or March of 2020 that this was going to be bad for the research business, and it didn't really turn out that way. Just like the pandemic didn't turn out the way we thought it would.
I mean, when I started 314, I was 39, and so it's hard. You need a little push out of a comfortable job like that to make you take a risk. You get comfortable around that age. But I remember talking to the guy who was the consumer strategist there at the time, and he's like 10 years older than me. So he was like 50 at the time. And he's like, man, I really wish I would have done what you're doing. But now that I'm I'm 50, it's kind of like that window's closed on me. And so honestly, it was just amazing timing. And like I said, no hard feelings at this point in time to NDR, but I will say I'm a pretty competitive person. And so, I'm I'm ready to compete always with them. And that's kind of how our business has been built, is through taking NDR clients. And so that's what we'll just keep continuing to do. So no, I think the pandemic and the environment that came after the pandemic is actually perfect for macro research. I mean, this is the most macro driven backdrop you could possibly have, and for me personally, like, we cover everything, but a lot of people know me from the oil days. Like, for me personally, like, oil is in center stage for so much of what's going on. And so if you don't understand oil, how can you do macro research in this environment? So I kind of feel bad for people who are trying to do macro and they have no background or understanding of oil. Oil's kind of just seems random to them. So it's been honestly a perfect environment for macro and for us in particular.
Yep. So were you involved? Some of the stuff that I loved about NDR was the breath work. I think we modeled a lot of stuff that we did over the years from their market internal analysis. Were you involved in that at all? Because breath is all the buzz these days, and I would love to just have a little conversation about some of these thrusts.
Yeah, we do a lot of work on breadth at 314, and yeah, I think NDR had done some stuff. I think we've taken it even farther and created our own type of thrust measures and stuff like that.
Yeah.
And to me, we wrote our second half outlook, and I gave you all some charts. To me, the big story for the second half of the year is, I think that there's a chain of events that's taking place, and it's really happened maybe even more aggressively than I could have foresaw. But we wrote our second half outlook back in June, and I said, look, I think the Fed is going to cut in September. I think Fed cuts reawaken an entire area of the economy, and this has been the most strangely lopsided bull market in history. Narrow, yeah. If you look at the S&P, I gave you a chart on S&P equal weight through bull markets. And
where is that one?
It's 20, 22,
24, I think. No?
24.
Yeah, this one.
That's it.
Like, this was my view, is that this is the play here, is if we're going to get a broadening, it's now, and the Fed cut cycle is really the impetus for that. And my view is that if you look at certain areas of the economy, whether you're looking at existing home sales or new car sales, these things are, everyone says, oh, the economy's booming, but existing home sales are back to where they were at the lows in 2009. New car sales are below their level in 2018. And so these are areas of the economy that have been dormant, and it's not a good time for these pockets of the economy. And I think it does show up in the market and does show up in poor breadth. And so as the Fed starts cutting, I think you see credit creation and this area of the market start to thaw out a little bit, and you get this catch-up trade that everybody's been waiting for.
Do you think it's really that simple? I mean, all of these weak or forgotten areas of the market, those industries that have not been participating, is it as simple as they need lower rates and then they'll join the party?
I mean, it's never that simple, but the
Right.
narrative that drives the market in the short term is that simple to me.
Right.
You know what I mean? And so, like, that was what we were really careful to say in our outlook was, look, I'm not even sure I believe this myself, but I believe the market will believe it. And that's all that really matters when you're talking about the next 6 months. And so, yeah, no, I think that it's not that simple. No, I mean, these areas are all kind of disparate and whatnot, but flows kind of flow in buckets, and so you're going to see flows into the equal weight. As we've seen, we're going to see flows into the small caps. I think there's some short covering. There's been some pair trades that are getting wrecked a little bit the last couple weeks. But there has been, like, leadership has been in the rate sensitive areas. I mean, home builders have been probably the strongest group off this last couple weeks, and
which has everything to do with interest rates coming off and Powell and the CPI, right?
Yeah, and you get a lot of there are a lot of people who are trying to say, well, home builders are actually going to get hurt when rates come down, because, like I said, existing home sales will come back online. You'll get this unlocking of the this frozen existing market, and they're going to have to compete with that new supply. And I think that's kind of playing a little bit too much 3D chess. I mean, at the end of the day, if we're cutting rates, as long as they don't just go from 7% to 5%, these slow bleed lower in rates is going to be good for the builders and for housing affordability in general. So, you know, and when you zoom out, secular picture, we don't have enough housing in this country right now.
Yeah, and I'm not an economist at all, but what I see, I'm 35 years old, and I have way too many friends, or you know, just people in my family, maybe a little bit younger than me, that are still dying to buy their first home. And right now, you know, anchoring bias is real. Rates are at 7. When they come down to 6, their eyes light up. Oh my God, it's a deal. They're just waiting to buy houses, and I think it's demographics a lot of the time that drive these trends. No.
Yeah, man. There's we pointed that out back in 2021. It was just like the millennial group, that older millennial group, 35 to 44-year-olds, they've delayed household formation, delayed having kids, but that's a massive bulge of demographics there.
Yes.
And so there's the housing shortage is real. That secular story is going to play out. So I mean, who knows what happens over the next 2-3 weeks and stuff. That group's a little overbought right here, but I mean, I think if you're going to get bearish, like structurally bearish on home builders because rates are falling, I think you're getting too cute in my view. So yeah.
All right, so let's talk about this crazy action over the past 5 trading sessions.
I was going to ask about that.
Yeah, like what is your breadth thrust of choice? Because I'm seeing the Whaley, the 7070. I mean, there's a million of them. What is, if you could have just one, what would it be? Looking for.
Well, I mean, so to me, we do it a few ways. The one that was really helpful for us that we saw last year, which you're not going to get here, is we want to see this is what we call our bottom spotting breadth thrust, which we wanted to see 90% of stocks above their 10-day and we were looking, I think, at the S&P 1500 on this study, but you also want to see at the same time half of stocks below their 200-day. And you don't see that. I don't know that I've seen that one before, but that one is almost a perfect year out track record for calling bottoms, you know, because you're looking for long-term problems in a short-term thrust. And when you marry those things together, it looks really good.
I would imagine we got that signal off the pandemic lows in May, June 2020, or no?
Yeah, we did. I believe so, but that was such a fast move. I believe we did get that one, but we, you know, they happen maybe once every 2-3 years historically. It's pretty rare. But the one that triggered last year was at the very beginning of November when we had that kind of V-shaped recovery off the lows. And to me, that was like, all right, these aren't the moves that happen in the middle of bear markets. These things happen when you're coming off of a bottom. So it helped us to get more bullish there.
And how about just the idea of these thrusts occurring at all-time highs? Is that really unusual when you look back at these data sets?
No, and my feeling was we went through a period though. I think you want to get more breadth thrusts confirming in this environment, because I think there is something about the market structure that's creating these are happening more frequently. And then you had a lot of false signals. Like we had there are major breadth thrusts that were triggering at in December of 21. And so that made me a little bit, then I think we also got some early in 2022, and obviously those turned out to be pretty bad signals. And if you look like 1 year out, maybe they weren't so bad, but no one wants to use that as a buy signal to get in at especially in December of 21.
Like what kind of, was it like S&P 500 longer term new highs that were probably triggering late 21?
My recollection was it was a lot of the X percentage over moving averages. We do one where we look at we do 10-day trend line slope, which is totally our own thing, but it's a little slower to move. So we take we take a regression trend line, a 10-day regression trend line. We run it over every stock in our universe, and then we look for like a 90% positive regression trend line, and that triggered. And it's a very tough one to trigger. So to me, it got me very like skittish. Like, okay, we have to put these things in the penalty box and confirm. Like, we don't want to be. I don't think you want to be, if the Fed's about to hike, this was our framework, we're going to tighten further, then you want to discount these breadth thrusts. But when we look out now, I think you can trust them because the Fed's about to ease. I think the easing bias is in place. And so that's how we're handling it, at least.
So we were talking internally. Some members of the analyst team were very excited that you're coming on, and I just got to tell you what we're dealing with. We use 55% for our breadth thrust signal on the 20-day new highs. We got 54.87% yesterday. I said to Grant, we're rounding up. It's 55. He said, no, I don't think you can do that. I said, I'm not a statistician. I think you have a much better background in this than me. Can we round this number up? It's a 1/10% away from our signal. What do you do in this instance?
There's really no right or wrong answer. It's kind of whatever you want to do. It's there is I think that the very particular technical analyst would say, this isn't horseshoes. Close doesn't count. You actually have to hit that number.
All right.
And so I think that's probably where I would go. But at the same time, I don't think it's wrong. It also is how you back test it. Like if you back test it and you're like, because everything we do is back tested. Like we won't trust anything if it's not. We back test Hindenburg omens. We back test bearish engulfing candles. We back test bearish engulfing candles, and we adjust the size for, okay, that day was 5 times the size of the previous day. We back test everything. We've broken down every single correction in the market that's 5% or greater going back to 1950, how those corrections resolve, what's interest rates doing. We do everything. And so my answer would honestly be, from our perspective, however you back test it, let it roll with it in real time. So if you said 55% and you didn't have like a rounding function in your back test, then I would be pretty strict about it and say, okay, this isn't technically a signal.
All right, that's what we'll go with. I'll find out. I don't know how they've back tested it. I will find out. But I like that answer. I think we've exhausted the breadth conversation, and people want to know about your take on commodities. I saw a tweet from you. You didn't just mention, you mentioned reducing commodities and equities and increasing fixed income in your model portfolio. Maybe talk a little bit about what goes in, or what's behind these moves.
Yeah, so I think that was misunderstood, if I'm understanding, because we had an oversized cash position, and then a few weeks back, or maybe 3 or 4 weeks back now, we went overweight fixed income bonds duration for the first time this year, and we've been underweight this whole year. Yeah. So that was the move we made. That's our discretionary portfolio. Really, there's 2 sides of the service. We have a discretionary portfolio where we basically take all of our studies and we say, okay, here's how we position ourselves. And then we have a bunch of models that we run, asset allocation models, and a crude oil model, which our benchmark on commodities is the GSCI, which is like 70% energy commodities. So really, when we say, hey, we want to be underweight commodities, we're really talking crude oil, which, that's the commodity I know the best anyways. So our model is long oil at the moment. And this is one of those kind of strange things you have to deal with, where the model is long, but I don't really love the signal. But I always defer. I ultimately will always defer to the model and then explain to our clients, like, hey, this signal suggests we should get like $100 oil within the next quarter. I'm very skeptical, and the signals are not perfect. It's like, we have probably the strongest, most accurate crude oil buy signal on right now, and it's still only like a 68% accuracy rate. So these things don't always work out, and you just have to be ready for that. So with all that said, my personal feeling is that oil's set up for a pretty weak second half, to be honest, in commodities in general. Yeah. And
why do you say that?
Well, number one, this whole market has been propped up by emergency level cuts from OPEC and Saudi Arabia, and they've signaled that they're coming back to that oil's coming back to the market starting in October. And they're talking about doing 200,000 barrels a day, which is a lot of oil, every month right through into 2025. And that's going to be a lot of oil for the market to digest. Without the OPEC cuts, I don't know where we'd be. And so I just look out and see that. And then at the other hand, a couple other things. We are late cycle. I don't expect a recession myself, but the probabilities of a recession are higher today than they were at the beginning of the year, even though you see most economists saying, no, there's less of a chance. I think, in our view, recession odds have gone up. And so you definitely don't want to be exposed to crude oil if you go into a recession. And I do think this move with Trump getting in ahead in the polls and everything, And even some of the whispers are that Ukraine is looking for a peace deal with Russia now. I don't know how much that actually fundamentally impacts the market, but some risk premium will come out of the barrel. So your news flow, your supply side, and your demand side all are unfavorable for crude oil. If I look out like a year,
There's
doesn't mean.
Yeah.
Go ahead.
There's no way that the war ending could be good for the prices of crude and other commodities too, right?
Yeah, I don't know about, so like gold's on another thing, like very
Yeah.
bullish gold, and we've been very bullish gold. And so when I talk about commodities, I'm not talking about gold. And the other thing is, I just think you have to separate commodities out in this world. They're not going to move all together.
So you're talking more about the pro-cyclical stuff you're a little wary of in the back half.
The crude oil for sure, industrial metals. I just think they're like in our models, we've split everything out. So we have industrial metals off to by themselves, oil, energy stocks, gold, and metals miners, all separate sleeves. Because my view is that you're going to need to shift around in the next, like, say, even 5-10 years. It's not an environment like 2000 to 2007, where China was just building out their entire economy and every commodity got a bid because of it. I think you're going to have the green revolution that pushes at different points in time under the correct governmental regimes and stuff. Industrial metals, you're going to have geopolitical stuff that drives crude oil and supply disruptions there. And then you're going to have monetary, fiscal, all the stuff that we're going through that's going to drive gold. So these things could rise and fall at different points.
Where do other, maybe a little bit bearish traditional energy, but where do some of the other energy markets fall in your view? Stuff like coal and uranium.
I don't really pay attention to them, to be honest, just because they're too small for our clients. Are mostly institutions and they're very small markets. And so I do have a lot of interest in natural gas right now. There's a lot of people who are asking me, can you bring out your I used to have a natural gas model back in the day. Mm-hmm. And we've had some big clients who are investing in data centers, for instance, and they're like realizing the amount of energy intensity of these data centers. And so they've been coming to me and being like, hey, what's the play? And all roads to me on that front lead back to natural gas. It's just timing that market it's a tough market at the time.
I mean, this Cheniere Energy chart looks good. That would be a company that stands to benefit.
For sure. Yeah. I mean, there's a few like high quality energy stocks that you just don't sell. And I'd say Cheniere is one of those.
Yeah.
Another one in that group would be Williams. We've had that as a recommendation to our clients for a long time. They own the Transco pipeline, which is the most important piece of, could be the most important piece of energy infrastructure in the entire United States. And so when you can buy an asset like that you just hold it and let it do its thing.
Probably pay a nice yield too, right?
Something, 5 something percent, something that people might start paying attention to again once rates start coming down.
We had a question in the chat. I think some of the people just want to know your opinion on MLPs.
We got a lot of questions, actually.
Yeah, a lot of
that one of them on MLPs.
I'm kind of, they're okay, but I'm not crazy about them, to be honest. You have to pick your spots and pick the companies that are exposed to the commodities that you want. It's not everyone treats them like there's just some kind of monolithic asset class, and I don't think we're there yet. I do think they're going to move. If crude oil falls, it's not going to be like MLPs are dumped like a E&P stock, but they, in general, you see them react. I mean, they get sold and marketed to people as if they are toll roads and they all just kind of have no commodity exposure. But if crude oil does fall, if we do have a weak Q4, Q1 period here, that group's going to get hit. So they're okay for long-term holds, but I'm not like pounding the table on them or anything like that.
All right, a couple more I want to get to from the chat. We get a lot more than normal, I would say, for questions from the chat. Oil services versus refiners next three months out. Do you have an opinion?
Oh man, I guess if I was forced to pick one, I'd pick refiners. They've been beaten up pretty good. And I don't think the economy is going to a recession. So, they were bid up way too high. And we were talking about, this is like a pretty juicy short back in March, April period. because basically what happened was Ukraine started bombing Russian refineries, and so everyone just bid up the refining stocks like crazy. And they've come off of that. They've retraced that entire move. I don't really love the group, but I definitely aren't. I'm not going into oil field services in this environment. So I'd say refiners. Most of those companies are pretty fundamentally sound at the very least.
All right, what else did we have here? Someone asked about residential construction employment. I guess you had a recent take on that. I don't know what that
Yeah,
is.
that's a big part of our recession framework. We got starts this morning. I haven't seen the starts numbers, to be honest, because I was prepping to come on here. So starts came out this morning. I'd love to see what those numbers were, and that's something we'll look at. But setting that aside, I think there's some slack emerging in the residential construction payroll market. It's we model it out. We take a bunch of different inputs, and then we model that out and say, okay, what's happening on the rescon payroll side. And for the first time in years, we're seeing the potential for job losses there. And the reason we look at that is because you see residential construction payrolls decline before every recession, every modern American recession, like 8% decline. And so our model suggests you should expect like a 3 or 4% decline at this point. Multifamily's a mess. Multifamily's in a recession at this point. And so we're watching it intensely. There's the setup is there for weakening. That's part of the reason we added bonds. Like this is the first time we've seen any risk of a recession in a long time. So bonds can actually hedge your stock portfolio. So that's why we went overweight bonds here 3-4 weeks ago.
So risk assets probably want to see rates come down, but they don't want to see rates come down too much or too quickly, right?
Yeah, I mean, that's a little bit of people do these historic studies and are like, hey, when the Fed starts cutting rates, it's actually bad for the stock market. And obviously that's because most of the time the Fed's cutting rates, the economy's in trouble and we're fixing to go into recession. And so, yeah, that's the really simple takeaway. If we're going to have a soft landing, that soft landing, when the Fed starts cutting in a soft landing, actually markets rally like 10% into the first cut of a soft landing, and they continue rallying after that. Right. Same goes for yields. Yields start discounting the first cut of a soft landing about 3 months in advance, which is another reason why I think 10 years is going to have a little bit of a tailwind here. Is like, I think the Fed's cutting in September. I do think we're getting a soft landing. So, I think yields are just going to have some kind of downward pressure there.
Yeah, so soft landing is one of these phrases that we hear so much these days. What exactly does it mean? Like when you go back and back test the past soft landings, like what's your criteria? What are you looking for? It's like rates come down slowly. Explain to people what does that mean exactly?
Well, there's a ton of literature from the Fed about it, and I would just call it like we only have like 4 instances that we can classify as a soft landing. So it's very rare. It's not like there's a lot of cycles to follow. And whenever you post something on Twitter about soft landings, that's the first thing that someone wants to chirp at you about is like, oh, how many of these? It's like, how many recessions is there? How many cycles are there in general? How many days in the market do we have? Period. Just like, if you really want to be statistically sound, none of these things have enough counts to matter. So with that said, there's like 4 soft landings. I basically would call that times where the Fed's been hiked rates and then began easing policy without a recession on the other side of the easing cycle. And so, the Fed would call it like a mid-cycle adjustment. The easing cycle is much more shallow, like just like kind of what's being priced in right now, maybe 2 cuts this year and 3 cuts next year, that kind of a price action versus the average recession. The Fed's doing emergency cuts. They're cutting the Fed funds rate 200, 300 basis points within a matter of months. It looks totally different, and we'll know it if we're getting that kind of a move versus the soft landing mid-cycle adjustment type of cut.
This has been awesome, Warren. Thanks so much. Spencer, can we drop a link to the 314 research in the chat for people so they can check them out?
Oh, yeah. His link, I'll drop in the chat now. It's in the description as well, but there it is in the chat. It's 314research.com. Bring it up on the screen now. This has been awesome. Thanks so much for coming on, Warren. This was a ton of fun.
Thank you for having me, guys. It was great to meet y'all, and hope to see you again soon.
You too. Thanks, man.
Next time we gotta get him on with JC. That was good conversation.
Yeah, actually, somebody in the chat said, "Oh, now I know why JC's
I saw that
not here because he's taking his daughter to the doctor." So shut that down.
Yeah. Yep. All good. All right. Ring that bell. We're open. By the way,
Bang, bang. More fireworks today, or a little bit of backing and filling finally? What are we getting here?
oh, that's the question.
First chart I look at is Bitcoin.
I'm not going to make any judgments off of a minute and a half of action, but why don't we look at some individual stocks, which we
Please.
have not done today, believe
Give
it
me
or
the
not.
news, sir.
All right, let's just start with the earnings. What the hell? Oh wait, I'm being told to check slide 3. What's on slide 3? Is that relevant to what I'm about to say?
No,
No,
ooh, but I
sort of.
love it. Oh,
Okay, good chart. We'll get there in a second. Start with the earnings. Very mixed bag this morning. Johnson Johnson flat to up, right? It's up less than 1%, so I guess that technically counts as up. They beat and they beat. They raised their sales guidance for the year, and their adjusted guidance came in at the higher end of their prior guidance range. So a good report for Johnson Johnson. We had earnings from ASML overnight. That's not the story here. The story here on chips this morning is these headlines out of the White House that Biden admin may be weighing more restrictions on Chinese imports into of chips. So
So the China stuff is just getting punched in the mouth today. You know, AMD down big, Micron down big, ASML is down big. Yeah. Look, these stocks can't go in a straight line higher forever. The equal weight semiconductor fund holding up a lot better than a lot of these individual names, down 2.75%.
yep. JB Hunt down about 4%. They reported a drop in sales, lower freight revenue, and higher insurance costs.
Well, Spencer, they keep telling me the transports are going to start working, but I keep thinking, well, let's see it then. A couple nice sticks, but we got a couple nice, sessions and everything over the past 4 or 5 days. Transport's giving back about 1% here today. I don't love this group. I still don't love this group. I think you could pick your spots. I think the marine shippers look good. I think some of the rails look okay. I think FedEx is shaping up really nicely, but I don't know. There are better ponds to fish in right now. Period.
Speaking of bitter ponds to fish in, Interactive Brokers, although it's down about 3.5% this morning.
Put it back up. Put the earnings chart back up too. Interactive Brokers, incredible. This base, we were pounding the table on it last year. One target hit, kind of in the middle of the range here. But this is a group that we do really like. And, Spencer, capital markets, broker dealers, even some of the data companies, credit companies, asset managers, private equity stuff, big banks, now the little banks too. It's all working in the world of financials. And we said months ago, look at the internals in financials. Far better than something like industrials or discretionary, right? This breadth expansion at the sector level has been going on for a while now, right? Started with the big banks. Insurance was already there. Capital markets joined the party. Now we got the little banks. Like, everything is working in financials. I will continue to say this is the group for the second half of the year. I don't think there's a better group to be looking for long opportunities in. Space is red hot. Let them dance, let them cool off a little bit. It's been quite a week or two for a lot of these names. Pick your spot. Yeah. This is the group right now, 100%.
All right, I've got a couple.
We talk about. Sorry. We talk about all this tremendous price action from small caps. There's an argument to be made that small caps is just an index of regional banks and biotechs, right? So if you're wondering who's driving, it's financials in a big way.
I've got a bunch of random news headlines from yesterday and overnight. These stocks are not important, but they were all moving. I don't think we got the charts. I'll just rip through them quickly. Eventbrite EB announced a deal with TikTok, so that thing went off like a rocket ship. I think it had its best day ever yesterday.
Yep.
It was up like 20% or something. So big day there. Similar spike that didn't hold. Taboola, TBLA. This is the online advertising company that you see the ads at the bottom of every website. Yeah. They're going to be doing some. They struck a deal with Apple. I guess they're working on this deal for a long time with Apple. Apple is doing ads through Taboola. So TBLA popped on that. GitLab, GTLB reportedly exploring a sale. So that stock is up this morning.
Is it going to be to Google or not? Is what people want to know. It's like, I've been in this one. I was in the hubs. Now I'm out of the hubs. Like these Google M&A plays have not been working for me.
Who can say?
I don't know if other people have had more success. Is there any more color there? Like, why are they exploring a sale? I thought they were hoping that Google would be their dad.
Well, they're backed by Google. That doesn't like Google is an investor.
Ooh, Datadog.
So yeah. I always confuse GitLab and GitHub. GitLab is the shittier one.
I bought one of the meme coins this week, Spencer.
What? Well, of course, you're the chief yellow officer.
I'm in the bank, but this is my first one.
Oh yeah, I know. Okay, wait, what is it?
I'm in the bank. I think that's a meme coin. Listen, forgive me. I don't hang out in those corners of the internet like our co-host friend JC here does, but I think the bank is one of those memers.
BONK?
The bank.
0.00. How many zeros? I can't count.
The number, the price tells me it's a meme coin.
1, 2, 3. Is that 4 or 5? My eyes. I think it's 4.
I want more zeros. More zeros means more juice, people.
Okay, wonderful. A couple more things quickly. Roche reported early preliminary data for a phase 1 trial of an oral weight loss pill. So Roche was trading up on that. It is phase 1. It is early data, but it looked good. The data was good for that. And last one I got was Five Below. Bye-bye to the CEO.
Ooh, Sean's short that. Yeah, he was excited. Just get a nice down move. Oh, sick. Great trade, Sean. Great trade.
One more. Spirit Airlines lowered their guidance. So,
I mean, there's nothing left to be said about this company that hasn't already been said.
Yeah.
Billy Cunningham, shout out. Billy from Twitter. SIBO, definitely not a top. Not a top. I don't know if it's the best bull market stock, but it's not a top. I like SIBO long term. I like that one for the IRA.
The IRA.
The IRA. Look, why don't you finish the news here?
That was the news. I'm looking at what's up and what's down this morning, and it's a lot of the things I just mentioned, right? So,
do you think the chat is sick of me ranting about the momentum thrust in small caps, or can I do more? Because I have a really nice chart that I would just love to
do one quickly, and then we have Mary here, so I would like to bring her on.
Oh, and Jason Pers wants to come on and talk about some things. Can you send him the link?
Wait, Jason's here too.
Jason's gonna come do a bit. I don't know. These guys, my morning show co-hosts over here, they cancel on me like, right in the middle of the morning, and I prepare enough talking points for my time, and then I figure out I need like 10 more talking points. And
I had a little bit of I had like a mini heads up last night, just a mini heads up.
I woke up this morning and JC's like, "Happy birthday, Strazza! You're doing the show alone." I'm like, "Thanks, bro." So lucky for me, I have a lot of great, smart friends. We got a deep bench on the analyst team. So I thought
deep bench.
So let's bring Jason on, and then I'll rant more about small caps later.
All right, and then we're bringing Mary on. Jason, you're here. He's here. What up, man?
Hey, good to see you guys. Good show.
We need a bumper for this man. We need a bumper.
Happy birthday, Strazza.
Thanks, buddy. You guys are all so kind. Can we get Jason a bumper? I think it's time.
Yeah, we can try.
He's earned one.
We'll get Jason a bumper.
That's exciting.
So talk to me, friend. So Jason and I have been playing telephone tag for 2 days now. He's been calling me. I've been missing. I've been calling him. He's been missing. I was, fuck it. Let's just do it live.
Let's just do it live. Honestly, we've done that for 3 times now. Since Friday. We got on live. We were like, we're going to talk after. We didn't. Monday, we're like, okay, we're just going to do lives, I guess. It's fine.
It's a fast market, bro.
It keeps happening. It's quick. I mean, good show today. I'm excited that we get to continue to talk about breadth, man. It's just great. I'm sure everybody wants to just continue to talk about breadth forever. I brought some charts. The first one is just for you.
Wait, my fault. Hold on. I didn't add them to the deck. That's my bad.
No, you're good.
1 second.
I love it when people.
I knew I forgot to do something.
Salzy says, "What's up with VKTX?" I don't know, man. My calls are going to 0. That's what's up. That's what's up here.
Oh man,
that's the only GLP-1 stock I want to hear about.
All right, there we go. I guess let's start with slide 3. I don't know.
Start with one.
Well, yes, 3 in our deck. I'm talking to Fonz here. Yeah, we'll start there.
All right, this is
Talk to
just for
me.
Strazza.
I
Strazza
know
was
where
like,
this is going.
no matter what, can you do anything but talk about breath? And I was like, you know what? I got one that I have to use. I actually started going through them this morning, and I was like, okay, I have to use one just because this is super interesting, right? This 1 month performance. Small caps is all the way in last place for most of the month, and then it just jumps all the way to first place. Not much more to say than that than you've already said, but that's quite interesting, quite telling. Nice to see it outperforming. I have all types of different assets, different sectors in here, and it's outperforming them all. That's quite interesting. And like you just said a little bit ago, looking at the KRE, regional banks in general, I like it for a lot of reasons here. Also, the yield curve should be widening here. That's usually pretty bullish for bank stocks as well. So, I mean, that's going to boost small caps. So, I like the way small caps look. I'll just end it there so I don't, go over what you've already talked about.
Listen, do you remember last year, earlier this year, when market participants and analysts are oohing and eyeing about the performance gap between, I don't know, NASDAQ 100 or the S&P 500, and then the lowly small cap index, Russell 2000, right? Could it be that now, for maybe the back half of this cycle, that relationship flips? And then we start complaining about the inverse and charts that look like this. Would that be fine?
Well, what's funny is you and I talked about this yesterday on the chart report. And when we were on the chart report yesterday, we said, now the bears are saying, now this is late cycle environment. Now we have breadth kind of widening out. And it's crazy to think that, because once again, it's the same argument that they made this whole rally. This rally's thin. There's not much in this rally. Therefore, we have to finally get to this point where breadth widens out. Finally, breadth widens out, and you're going to say that's late cycle environment. Now we're going to crash. I don't understand. I'm just saying here, I'm not saying, we're traders. We're not trying to predict what's going to happen in a year from now. Sure, the market could crash in a year from now. I have no idea. But what I can tell you is that you're going to lose a lot of money as a trader not being prepared for those upside moves. They don't always happen like this. Right. So just kind of looking at it and going, hey, you want to be long these sectors that are going up. You want to be out of the things that are going down, especially the things that are showing relative strength. I absolutely love the way the market is positioned now. It's looking really good. It looks like a major shift. So I like the way that looks. Have some more charts too, so if you want to go through them.
What's next?
So I'm not sure what's on your deck. What's on my deck is the false breakdown signal. So we talked about this the other day, and I posted this into our Slack group too, which was the Bitcoin false breakdown signal.
Oh, this is good. Yeah, you got the signal.
Now we did this the other month. You see the one back there? That's back in last year, actually. Or sorry, earlier this year. We had that false breakdown signal. We traded it to the 70K zone. We got all the way up there, sold that trade just as a short-term swing trade. Same thing here, and so many people said, hey, this can't happen for this reason. Hey, this shouldn't be happening. And it's like, sometimes you just have to trust the price action, get into the trade, look at the risk to reward. The risk to reward is it's skewed to the upside. You have this very tight stop. You have this false breakdown signal. You have to take those types of trades. So
who in their right mind would look at this pattern right now and say that doesn't make sense, though? How many patterns have we seen that look exactly like this that have not triggered a downside resolution and instead failed and ripped higher? And in a lot of cases, targets have been hit at the upper bounds and now exceeded.
And that's something you've been posting, a lot, is all of and this is bull market 101, basically. You have these false breakdown signals in an uptrend. It keeps happening again and again and again. That's bull market 101. It gets everybody excited because the shorts go, okay, great. I'm finally going to get my short, and then it breaks down, and then it goes right back up to the upside. That's bull market territory. So I'm seeing that we're in a bull market. There's a lot of reasons here. Part of the reasons of all of my slides here is to kind of show what's going on with the dollar and rates. So looking at Bitcoin, that's another one to say, hey, what's going on with the dollar? The dollar could be weakening here. Let's keep going through these slides. And so now we got the pound. So this is one, and I always make fun of this trade for myself because I trade the pound a lot.
Love this.
I trade it against the yen. I trade the pound straight up. And people I always say, if you're in if you're in Europe, you're going to hate this trade because nobody in Europe ever buys this trade ever. And I get it. If you visit over there and you're dealing with the things that you're dealing with in Europe, sometimes it sounds crazy. However, we trust the price action. We trust the positioning. Looking at the positioning continues to be lopsided. And then we get these breakouts, which is a band squeeze breakout, my favorite pattern. So that means volatility tightening. You could either use Bollinger Bands, you could use a triangle pattern, whatever you want to use. Then we get this nice breakout to the upside. So that's another one to kind of say, hey, maybe we should be paying more attention to what's going on in the currency markets right now too, and how that pertains to the overall market.
Is the currency market driving this, risk asset rally, or is it the bond market, or should we not even kind of split hairs about who it really is? It's both.
Great question. And I think it's a little bit of it's all of them, right? So but they all work together. And right now, I think the macro driver, if I was to really narrow it down and say, hey, this is fundamentally what I believe. Not that it matters, like you said, I don't know if we need to even split hairs. But the macro driver is obviously the bond market, obviously what the Fed's doing, obviously what global central banks are doing. And global central banks are cutting globally. So that's a thing that you have to look at that people aren't really paying attention to right now. They're just looking at the Fed and going, okay, well, the Fed itself is cutting rates, or going to cut rates soon. But globally, we've already started to cut rates. So rates are coming down globally. The currency market's kind of saying something too. So once again, we got to see what this central bank does compared to the rest of the world. That's really going to drive the dollar, but the dollar even looks bad too. The euro is the next chart after that. So the euro also is starting to make a 100-day high. I mean, it just continues and continues and continues. And then go to gold. Gold's the next chart, I think. Gold making an all-time high. So what we're seeing here again and again is, hey, something's going on with the market. Something's going on with the dollar. Liquidity is coming in. The dollar is weakening, and we're also seeing the dollar weaken in real time. It continues to break down lately. So once we get out of that major range on the dollar and maybe break 100, we can finally decisively say the dollar's going down. But here, the dollar still looks weak. And then the next chart, I think, is the yield curve against everything else. No, sorry, crude oil. So crude oil here. Another one that I would say, I heard your guest earlier, and I have the same thing, is where it's, if you look at fundamental models, and once again, fundamental models are absolutely ridiculous because the price action is what matters more than anything else, at least to me. But if we start to get a breakout here with the fundamentals that we have and the positioning that we have, crude oil's absolutely, like he said, the conditions are here for crude oil to at least hit 100. And people love the $100 thing just because it's clickbaity, but at the same time, the conditions are here. Look at that triangle. Look at the squeeze. We're squeezing into another band squeeze breakout that we're seeing across the board and all these things against the dollar. So I think this is another one that could go higher. And I just have one more chart on there, I think.
I tend to agree with you, Jason.
Mm-hmm. And also, Stephen, you should like this one. So I spent this morning taking my charts and turning them to white. So just for you this morning. so
we appreciate that. Thank you.
Of course. I turned them all white. So that's doing that for Stephen. I'm sure you feel better now. So happy birthday.
I have a thing about it. I can't explain it. It's just me. Thanks, buddy.
I get it. They look clean. But so looking at this chart, if we're looking at bonds, bonds obviously breaking down and gold. But what I pointed to is the conditions where gold, and I pointed to this a long time ago too, where gold can actually move higher, which is when the yield curve starts to invert, yield curve is flattening out, and then rates are topping out. So most of the time you see gold have the conditions where it's kind of building energy around that time, and then it starts to break out. Gold breaks out, the S&P 500 starts to move. So all of these things look really good. I'm just saying the dollar is looking weak. Everything else is looking really good. I would stay with those positions that we continue to talk about and continue to like.
So are you saying based on the yield curve, stocks should do what?
So based on the yield curve, I'm not saying that stocks are perfect. What I'm saying here on the yield curve is that gold has certain conditions it really likes.
Yes.
The conditions that gold really likes is that the Fed rate is starting to top out. The yield curve is coming out of inversion. And so we're seeing this kind of gold rally happen just perfectly. But also going across the board, all dollar sensitive assets are also moving. So, you know, the chart of the euro, the pound. I mean, go look at the currencies right now. They look really interesting. And that also bleeds into the rest of the market. So what I'm saying here is it looks different than what we've seen lately. And this posture really tells us what we're onto with breadth, small caps, the KRE, and so on. Even gold, silver. It's right. I think it's definitely right.
You know, I love what you did with the currencies too. Like the greatest tailwind for risk assets these past couple cycles has really been a falling dollar. If you just simply look at the different pairs, like you showed the pound and the euro, and make a list, and the pound is breaking out, and then maybe the euro breaks out, and you can go on down the list, and they're all breaking out against the dollar, then you could look at the chart of Dixie and say, we're going lower. And then you got to look at charts of risk assets, whether it's gold, stocks, Bitcoin, I don't care, and say that can only be a good thing for these guys.
NEM. So I saw somebody in your group said NEM. You know, like the gold miners look fantastic. I mean, they're perfect. You know, I've seen that Ian's done a lot of work on that too. So I mean, gold miners look fantastic. Platinum looks fantastic. I mean, you go across the board in the precious metal space. It's one of those things, like you said yesterday. Spin around, throw a dart, hit something. You'll probably make money, but you want to be in the winners. Those are the ones that are going to outperform. NEM isn't exactly the outperformer at the moment, but it is a great brand, a great company. It could be soon. So we'll see where those all end up.
Jason, thank you so much for stepping in and having this little chat with us this morning.
Of course.
I hope you listen to my recess in like 5 minutes, because I'm buying gold. I've been very active buying gold, and I can't wait to talk about it for recess.
Awesome. Can't wait,
Thanks,
man. All right. Thanks for having me on, guys. Bye.
Wait, we gotta bring on Mary. It's Wednesdays. We do mornings with Mary on Wednesday. Let's go.
Mary, good morning.
Good morning, gentlemen. Happy birthday, Steve.
Oh, thank you. Before we dive in, because you brought some charts that I really like today, Spencer, maybe you should do another market update. This market, people, is Teflon right now. Dips are being bought so aggressively. They already reversed these ugly candles this morning. Look at the Bitcoins, look at the cryptos, look at the Russell 2000. These candles are wild.
Shout out Kathy Wood. A lot of ARC names getting bid up this morning.
That makes sense. Go on down the line and say, what interest rate sensitive group hasn't caught a bid yet, right? They all should be going. ARC was a little bit slow last week when the regional bank started going and the homie started going. Now they're here. Speculative growth has arrived. The animal spirits are out. Go ahead, Mary. Oh, yeah. What do you got?
Well, so before I talk about what I've been trading, I've got some news. Big news. You ready for it? Even on your birthday, Steve, I've got big news.
Talk to me. What's going on?
Wait, the image. Flip it around. Wait, Mary.
What? How do I flip it around?
Take it down a second. In your restream, can you click on the settings gear?
Where's the set? Yes, okay.
Okay, go to video.
Mary.
Video.
And then mirror camera.
It's not letting me go past. Oh, yeah. Okay, there we go.
There we go. Now do it again.
Oh, okay. Okay, here we go.
Yeah.
Now everyone can read it.
Let's go.
That's awesome.
So
congratulations to you.
Thank you. Took the test in June and actually got my results surprisingly fast this time. So passed, and level 2 down, 1 to go.
We're going to have just so many CMTs. We're going to have more CMTs than anybody ever had or even came close to having. I'm just so proud of us. Good for you. Louis actually pinged me yesterday because me and Louis both kind of stopped before we got to the finish line. He goes, should we take level 3 this winter? I said, you know what? I think it might be time. So we're thinking about it too. We might join you on level 3.
Ooh, let's all have a little study session.
I know. God. Been putting this moment off for so long. So talk to me about the charts you brought. I believe, I think we told a really good story about this Hut 8 Mining Corp because Spencer's getting some skin in the game. I know, Mary, you've been involved, I think, right?
Yeah, and that's, well, so yeah, I was pinging you last week and I'm like, all right, Steve, I mean, I feel like we just got the shake and now we're going to bake. And So, yeah, I've been long Bitcoin miners. I've probably got 5 or 6 or 7. I don't even know. I've lost count. But I was looking to add more exposure. And I actually, so over the weekend, was watching the markets, the crypto markets. And on Sunday, when I saw Bitcoin take out 60, I was actually buying Solana because that's all I could buy at the time in the crypto markets. And then first thing, I mean, it was the first order I put in at the bell at 9:30 on Monday morning was hot. Love the base, obviously. It's one of those bases that I just love to buy. So and it's already been working out really well. And I think this has, correct me if I'm wrong, it has insider activity in it too as well, right? So I mean, it's a no-brainer for me.
Activity. You got to join us on our Hot Corner call at Wednesday if you want to hear more about that, though.
1 o'clock. Members of the Hot Corner Insider, you know what to do.
Today.
It is. Woo! It's like it's your birthday.
Special Hot Corner birthday edition. All right, what else? We're running out of time.
Oh, yeah. Okay. So let's see. What else did I bring along? So similar base. I talked about this a couple of weeks ago, Blink. Again, it's one of those kind of left for dead, and it's got a huge base. I liked it around that 350. I got involved and it just wasn't ready. And so it, pulled back quite a bit. And now right again, yesterday, it closed above that for 350. And right now it's trading, let's see, 365. It's kind of been up and down this morning. So this one is got involved just yesterday again as it was closing at that 350. We'll see what happens, but again, it's that base that I love to buy. And you should look at the RSI on the weekly on this one because huge bullish divergence going on there. Yeah. So
and it's just really clean here at these pivot highs, which is what we love. The trend line break too. That's fantastic. Does this have a big short interest?
That I don't know.
I'm gonna try and check, but I'm freezing up here. All right. This
all right.
A lot too. What else?
Yep, good base there. I'm watching and back in Square. This is another one that I talked about a few weeks ago. Right at that, it was around 82 is where I got involved, and it just couldn't push through. Had to get out, and now again, I got back in last week, kind of as we were making that rounding local bottom, and now we're trading. I think yesterday we closed above that anchored VWAP from March. And so I think we go at least back up to that 82 area, 90-ish, to retest that former resistance. And then we'll see what happens because I guess, if our thesis is that it's, rotation into these other areas, then I'm looking for a breakout in this one.
Love it.
Yep.
Am I frozen,
also,
guys?
Go ahead.
I can't see you. Okay.
Oh, you can't. One other trade I just put on last week was CAT. So I've been kind of all over the place.
Oh my goodness.
Yeah, I've been trading a lot, taking off some of the winners, taking some of the positions off with huge gains. Really happy with some of the performance in the last couple of weeks. Put on CAT just again, kind of around that local bottom-ish area around that 320 is where we were watching to kind of see if it was going to reverse. And I mean, again, great winner now off of that local bottom and just kind of a different area that I typically focus on because I'm usually looking at the junky small cap stuff. So adding a little bit diversification in my trades here.
I love this, and there's a lesson here. I didn't get into this one because the correlation with Caterpillar and home builders is just like sky high. And I was in so many home builders. I said I chose my fighter. I already have the exposure, and now I look back and I'm like, how did I not get into the CAT? But that's what a bull market does to us, right? I'm a bull market trader. You never own enough, right? You never bought enough. You never have enough exposure when you're right. My grandma taught me when I was very young, make hay while the sun is shining. What does that mean for markets? When times are good, when it's a bull market, when we're thrusting like this, when breadth is expanding, everything's working. Mary, you're a perfect example of this. Buy it all. That's the time. Go crazy. Press the gas. Like, let's go. If we were doing this show back in 2022, you would get a very different Steve on here every day. I'm being obnoxious. I'm here with trade ideas literally every day because that's what I do in bull markets. In bear markets, I golf a ton. I like take up fishing. I like find a new hobby. I stay away from those environments. They're not for me. So right now is the time, my bull market people, to make hay while the sun is shining.
Absolutely. Good for you. There's not enough money in my account. I'm all in right now. I wish there was a little bit more because I've got other things that I want to buy. And so I've started selling, like I said, some of the winners so that I can start to finance some of these other trades that I want to make.
I'm ready for recess.
All right, let's go.
Peter makes a good point. Homies are up a lot more. Cats only up 10%. Here's the thing. When you're doing this using call options as your vehicle, they're priced appropriately for the beta of these stocks. So the cat call options will be far cheaper to make up for the fact that the expected move there will be smaller than the home builders. If you play it right, though, it's not about getting 25% instead of 10%. It's about beating the implied volatility. In other words, the implied volatility, the price of those calls that you're going to pay is based on the expected move. So if cat's beta is half of the home builders, maybe the expected move there is 10%, but the home builders, you need 20% to make the same amount of money, right? Because the calls are priced based on it. So you could hit something like Caterpillar, which traditionally may be lower beta, for 10%, and those calls maybe would have paid more than the home builder calls. I hope that makes sense. It's options pricing stuff. Anyway.
All right, let's go.
I'm all jacked up here. What do you guys got?
Well, what's this? There's slide 2. What's going on?
I told you, it's a bull market for gold. So I bought myself a birthday present. I got myself a gold putter and some gold golf balls, right? I have some skin in the game. This is how I buy gold, right? So when they ask me on the golf course, what's going on here? I'm going to say, what, you didn't know? Gold is at new all-time highs. I'm just acting accordingly. No?
Is that easier to see with the sun glistening off it?
Oh, that's a good point. I like that. Easier to find.
I have terrible eyes, so I'm actually like the guy that gets made fun of in the memes on the internet out on the golf course. I can't play with a white ball. If you get to a certain like level in golf and you're not playing with a white ball, you're just like the butt of all the jokes. So I'm out there. I got like neon colored highlighter balls, like, you know, balls with stripes on them, all this crazy shit. I was like, let's just go for the gold now. So I'm a colored ball.
You do you, Strazza.
I'm not afraid to admit it, and I hope I'm always a colored ball guy. Whatever.
I would totally be golfing with a pink ball.
Mary, what do you got? I got nothing, honestly.
Yeah, pink's great. I like pink.
You know, yeah, the CMT thing was my big news today. I guess headed out to dinner tonight to celebrate to the my favorite steakhouse here in West Michigan, and gonna have an excellent fillet that's just gonna melt in your mouth, and they make these amazing truffle fries. So kidless tonight, so it's just husband and myself, and we're gonna eat outdoors right on the lake, and it's gonna be wonderful. So
awesome. That sounds amazing.
Yeah, that sounds nice. I could go for a fillet tonight.
I could go for a wine recommendation from JC, but you know, he just doesn't
show
up anymore.
If JC was here, you know what he would tell you. Oh, fillet, go ahead and enjoy your fillet.
Yeah, flavorless, you know.
All right, members of Hot Corner Insider, the weekly strategy session is today at 1 o'clock. It is, of course, live. You can access that on our site in the members area. In today's email, you know what to do. It was mentioned all there.
Big one.
That's it for our show today. We went a little long, but we had fun, and we'll have JC back tomorrow. So thanks to Mary, thanks to Jason, thanks to Warren Pies for hanging out, and thanks to Strazza for doing the heavy lifting on his birthday of all days. We made him work hard for it.
Cool thing about the Hot Corner for anyone who's not involved is that I get to do whatever I want. So for a normal publication or some sort of column that we put out, we might have to maybe like write about something every week or every month. Not here. The market is on absolute fire right now. So we're triggering all these new entries for primary trend reversals. So we're putting out 3 new Screaming Hot buy reports this week because you got to make hay while the sun is shining, right? That's what
if you're wondering how to get access, if you scroll down to our description, it is the very first link at the top of the description where it says join Hot Corner Insider with the flame emoji. It's right there. Check it out. Steve will see you there at 1. Have a good day. Smash the like. Don't make money or hay, whatever your preference. And we'll see you later.
Hump day.
I can't take no loss. I don't even know what it